to my channel. I'm Doris and here to show you about the updates in my stock account. Today my stock account has earned $4,217. Today Dow Jones fell 430 points as the PPI data highlighted inflation and reinforced expectations of interest rate hikes. In my account today, my net asset of my account is $71,587. Today, I've earned $4,217, which is a gain of 6.26%. Right now, the total loss of my account is still $29,593.57. Today, SQQQ rose 5.72% to $35.5, and the RV rose 2.96% to $42.47. Today, the market generally closed down. After 12 p.m., it all decreased by more than 1%. The Dow Jones Industrial Average decreased by 1.26% to $33,696.85. Nasdaq Composite decreased by 1.78% to $11,855.83. S&P 500 decreased by 1.38% to $44,090.41. All throughout the industries, all industries showed a loss today, with the tech industries decreased the most. The auto manufacturing industry decreased for 3.12%, and software decreased for 3.18%. The CPI, retail sales, and PPI data released so far this week all showed that U.S. inflation remains high. Two Fed officials said further interest rates are needed to ensure inflation gradually returns to the Fed's 2% target. Some analysts are betting that Fed will raise interest rates by another 50 basis points in March. On the economic front, on Thursday, the U.S. Wholesale Price Index rose more than expected in January, reinforcing the expectations that the Federal Reserve will raise interest rates further in the coming months to curb inflation. The Producer Price Index, PPI, and Inflation Index tracking wholesale prices rose 0.7% in January, the biggest month-on-month gain since June, and above the 0.4% average forecast by analysts polled by Dow Jones. Core PPI, excluding food and energy, rose 0.5% per month-on-month and 5.4% from a year earlier. It is the latest higher than expected inflation report this week. On Tuesday, the Labor Department said the closely watched inflation indicator, January Consumer Price Index, rose 0.5% month-on-month, above the average forecast of 0.4%. The CPI rose 6.5% in January from a year earlier, well above the Fed's 2% annual inflation target. Analysts said bigger than expected PPI rebound in January, underscoring the continued inflationary pressures that could prompt the Fed to raise interest rates further in the coming months. Separately, the Labor Market Department reported the initial claims for jobless benefits in the week ended February 11th was 194,000, compared with 200,000 expected, and 196,000 previously. Continuing claims for state unemployment benefits for the week ended January 4th were 1.696 million, compared with 1.695 million expected, compared with 1.688 million previously. Philadelphia's Fed Manufacturing Index was negative 24.3 for February versus minus 7.5 expected and minus 8.9 last month. Housing starts totaled an annualized 1.309 million units in January, the lowest since June 2020, 1.36 million compared with 1.382 million last. Prior Thursday's PPI data, series of strong non-farm payrolls and stubbornly high inflation have put pressure on the Fed to raise interest rates. Analysts said continued hot summer consumer demand could lead the Fed to raise interest rates to higher levels in the future, aggravating the risk of a recession. Markets are increasingly saying the Fed will continue to raise rates until at least June, with investors betting that rate will peak above 5% and remain for longer, and the strong rebound in emerging market U.S. rate-sensitive bonds may be losing steam. Now, Fed officials largely insist that interest rates needed to be raised above 5% to curb stubborn inflation. Cleveland and Federal President David Mester said on Thursday that January CPI data shows the Fed had more to do to control inflation. She said a 50 basis point rate hike earlier this month was well justified, with rates needed to be above 5% are maintained for some time. How much interest rates will need to rise after rising above 5% will depend on data. Rising risk to rate inflation remain. Price stability recovery will cause some play. The Fed's action will slow economic growth and push unemployment. St. Louis Fed President James Bullard called on the Fed to raise interest rates further to ensure that inflation returns to the Fed's 2% target for some time. Even if the economy continues to grow and the labor market strengthens, raising interest rates could help establish a downward trend in inflation in 2023 by keeping inflation expectations low. J.P. Morgan chief economist Bruce Kasman believed both Wall Street and the Fed may underestimate what rates may eventually reach. There is a good chance that the Fed will do more than the markets have expected. The risk is that any consumers exhaust the cushion accumulated during the pandemic. Credit tightening will eventually transmit to the economy and trigger a recession. Private equity giant Blackstone expects the Fed to raise interest rates to 5.25% to 5.5% and remain at that level for a long time. And growing concerns about the prospect of a U.S. government default are at the highest level since the financial crisis. Congressional Budget Office predicted in a report Wednesday that the federal government would default on its debt unless Congress raises its $31.4 trillion debt ceiling in July through September. Treasury Secretary Janet Yellen warned last week that the government would face economic and financial disasters if the House fails to pass a bill to raise the $31.4 trillion debt ceiling. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.